That's all right. That's all right. Tim Arrowood here. Happy Wednesday, everybody. It is not April Fool's Day. That was yesterday. So it's a good thing I wasn't here yesterday. It would have been a mess. What are you doing? Get out of my way. Look, what? There he is, the man. I don't know. All right. All right, what's new, everybody? How's warm weather? Things starting to pick up a little bit? Starting to see some stuff? Thank you for nodding. I know you're not right in the thick of the real estate right now, but so you guys really, are you seeing some activity? Cool. We things picked up around our place, so a lot of stuff. Isn't that right, Matt? A lot of stuff. So anything, any mortgage-related questions? Anybody got anything's turned sideways that somebody needs any help with, or anything like that? No, it's all right. It's all right. I know all the lending questions, all the mortgages are easy, so usually not a lot of problems. So anyway, I was going to talk a little bit about credit today, and I was going to talk a little bit about what makes up credit scores and some things that you might find interesting. So I'm going to pass these out. It's called Credit and DTI, Debt to Income Ratio Basics for Realtors. So even though I shouldn't give this out because you won't pay attention to me, you'll read it, and then you won't look at me anymore and all that stuff. Multitask. Oh, there you go. What? Huh?
What are they selling?
What are they selling? All right. So, anybody here know what your credit scores are? Kind of have an idea? Yeah. Okay. So where do you go to find your credit scores? No. Credit Karma. And how about you? Have you?
I use Credit Karma.
Okay. Cool. Capital One. Yeah, that's good. And generally, Credit Karma is pretty good. If you've got good credit scores, it tracks really closely to what you'll see for the real scores. Like, so you've got mortgage scores, you've got credit card scores, you've got auto scores, you've got insurance scores. All the different ones have different models, but they're all generally, similar. But you'll find that if you've got an 800 credit score with Credit Karma, you're probably going to have an 800 credit score with FICO or TransUnion, Equifax, and Experian. When you get on the lower side, that's when things get a little wonky because the bureaus, like Credit Karma, is just not the same model. We call it, instead of a FICO score, we call it a FACO score because it's similar, but it's just not the same.
So you're saying if the credit score is higher, it's probably similar across the board, but not as low.
That is correct. Yeah, okay. Yeah. So there's some things to think about. So when we're looking at what makes up the credit, makes up the credit score, it breaks down similar to this: payment history, credit utilization. I usually say when I'm talking to a client, about a third of your score is did you pay as agreed, right? You said you'd pay $10 a month, you pay $10 a month. That's going to be your payment history. And then another third is about what's your credit utilization. So if you've never been late on anything, but you've got 3 credit cards that are at 105% of the available limit, then that's going to drive your score down. So, and then the other parts, credit mix, new credit inquiries, and things like that. So you can see that there are the big parts have to do with did you pay as agreed, and what's your utilization. So, for me, when I'm looking at credit scores, usually people care about their credit when it's low. So when I've talked to somebody about their credit and it's like, hey, you need to move up, or you don't qualify because of your score, then I'll be looking at things like, well, first thing I'll look at is what's the utilization rate. So it's easy if you've got a $500 limit on your card and you got $500 on it, then you probably have the capacity to pay that down. But if you have $15,000 limit and you got $15,000 on it, it's a little harder to just pay that off. So,
What about with those, the utilization, but I'm paying it off every time?
So what happens is the credit bureaus, well, the credit card companies will report to the bureaus on certain days. So let's say that you pay your credit card off on the 1st, and then you get back into it, and then the credit card company reports on the 15th or the 17th, which is pretty common. Then you're halfway into that month, they'll report, and so every month they're seeing that you're half full, right, or you're completely full. So one of the things you can do is you can actually reach out to the credit card company if you wanted to do that and say, well, we report on the 17th. Well, pay it off on the 15th of every month. So that way, when that amount hits, when that amount is presented to the credit bureaus, then they're going to say, oh, your utilization is low. So yeah. So or you can just get ahead, or but that's pretty common. So.
Now that pay on time, I
Mhm.
wonder if it'll say, even though, say, like your loan account, card, whatever it is, and it'll say, pay this amount between here and here,
Mhm.
a date spread.
Mhm.
But the actual due date's the 5th, but it says like after the 15th, you have to pay this
Mhm.
amount.
Right.
But they say that even if you pay within that window, they still consider it late if it's not on actual due date. Is that true?
So the bureaus will report 30-day lates. So what will happen is, like on a mortgage, and the one I think of most often is the mortgages are due on the 1st, late on the 15th. If you paid on the 16th, you'll probably pay a fee, but it doesn't show up on the credit report. So, but if you pay it on the 1st of the next month, then that's going to show a 30-day late. So I'll see some things like it won't show up on the credit. So I look at that sometimes when it doesn't show up on the credit report, but I can see that they're consistently paying it late and they're paying fees. That can be a little bit of a challenge, but most of the time we don't even need the unless it's showing 30 day lates, then we're not even going to need to see a copy of their statement. But that's the way it works for mortgages. Now there may be some other things, but that's generally the rule. Because when you look at the credit report, it's showing 30-day lates, 60-day lates, or rolling 30 days, rolling 60 days.
That's the major.
Yeah. Okay. So the credit mix. Now I've got a lot of people that have a credit score. Like if you start with a 0 score, somebody came in the other day and their whole family, they had financial problems 10 years ago, and they just swore off credit cards. We're not going to do any credit at all. So they said, well, can I buy a house with no credit? I said, well, there were Dave Ramseyites, which is fine, right? But I was like, well, yes, so we can do it. We have to have some alternative trade lines to do that with no credit scores. But I looked at the rate that they would have to pay for that, and it was significantly more. So I said, you can do that, or you can wait 60 days. I'll tell you how to get the score, and you can basically go from a no score to 670 to 690 score in 2 months. So that's the path we took, and they did a combination of they got a credit card, and they also got an authorized user. That's like the Mac Daddy of how to manipulate your credit scores to get an authorized user. So you got a uncle or a parent or a grandparent that's got this credit card they've had for 30 years, and it's got a $50,000 limit, but they never use it. Then if you get them to put you on as an authorized user, then you get the benefit of all that history that they've got. Mm-hmm. Yeah, and the beauty for the person that has the credit is they don't even, like, I can put random people on. Well, hello there. You put random people on, and but the credit card comes to me. I have to have your Social Security number, and I have to have some of those things. But the credit card comes to me, and you don't even have to use it. I just have to authorize it, and then I don't have to give it to you. So I'm not worried about you using it. You just have to be careful if you put somebody on, because if for some reason Grandpa forgets and buys something and then forgets to make the payment, then you live by the sword and die by the sword. So.
What about these folks with youngins over here, who your child is an authorized user,
Mm.
15 or something, hey, go buy
Mm.
groceries for me.
Yeah. So, I mean, I don't know if there's an 18-year. You have to be 18 to be for that to be on there. But let's say it. To be on a contract, you have to be 18 years old. So that might be something. But you can take somebody. So if you put somebody on, then they get the benefit, even they're 18 years old and you've had the car for 20 years, then they get the benefit of having 20 years of history and they're only 18 years old. Yeah. So that's a real. So you can, like these folks,
But
I
they
was,
don't check to see that you added them
no, it's, now there's, if there's nothing,
yesterday.
no, I mean, the score is the score. Now, we do look at the depth of credit sometimes. So, you really need to have, let's say, if somebody comes in with nothing, I'll say, get a credit card and, get I don't care what the limit is. It doesn't matter. It doesn't have to be big. So, get the card, buy a cheeseburger, and pay it off. And if you're going to, every once in a while buy a cheeseburger, right? Or that used to be like $5. Now it's like $25. So, but that's a method. And then if you want the best, you're going to have at least one revolving or credit card, and then you're going to have one installment. You don't have to have an installment, but but that is really when on a daily basis I'm looking at people's credit and I'm looking for first score, and then the next range here is like what a score range is 740. I can go down to a 580 credit score with FHA and VA. It's not always doable. There's a reason why somebody scores 580. It could be that they were late on their mortgage 2 months ago, so their score is okay. I can work with that, but there's another layer that it says, yeah, you were late on your mortgage and you're trying to get a new mortgage. They don't really like that, right? Because if you haven't made the mortgage a priority before, are you going to make it a priority later? Right? So generally you'll see that, the higher the score, the more options you have and the less you pay for credit. You're going to get the best rates at 740. If you're doing some non-QM stuff, you need to be higher. If you're going to have mortgage insurance, there's some benefits to having a higher than 780 credit score for mortgage insurance. But anything over 700, I would consider somebody for a conventional loan. Anything under 700, if you're putting low money down, I would probably lean towards an FHA or some other government type, because the mortgage insurance is going to be less expensive, and the rate is going to be better. So now, if you're putting 20% down and you got or 25% down, you got a 620 score, I can do that. Your rate's going to be higher, but there's not going to be any mortgage insurance. So the effective rate it's still better than getting something, better than having an FHA loan that has a better rate, but then it's got mortgage insurance on top of it, even though you're more than 20% down. Now, there's some other reasons I might do that, because maybe it's debt to income ratio or something like that. But but generally, lower your score, the less options you have. Higher your score, the more options, and the less you're going to pay for credit. We have a 100% financing deal right now that is a down payment assistance program. It's not a THDA. I can go down to a 580 credit score, and I can do debt to income ratios, not both of them together, but debt to income ratios of up to 55%. But there is no income maximum income like you would on THDA, and there's no geographic limitations or anything like that. But again, a high score isn't always enough. Mortgage rates, thin credit, or collections can be a hard stop sometimes. So fixed versus revolving. Revolving is credit cards. The big impact is down payment balances, and then fixed we're looking for the word I'm looking for. Anyway, the not revolving would be cars or student loans, and really the only impact for those is going to be whether you're late or not. If you started out with a $25,000 loan on a car and you've paid it down, it doesn't really matter, right? Even if you just got it, it's going to have the same impact. All they really care about is, are you paying as agreed? So, and then as I mentioned, authorized users are on clean aged credit cards can help boost scores fast.
So when you're meeting somebody
Mm-hmm.
as a client,
Mm-hmm.
somebody, say like here,
Mm-hmm.
is meeting with you, and they are the Ramsey Knights,
Mm-hmm. Ramseyites.
are you going to tell them to, you going to suggest to them to be an authorized user
Mm-hmm.
to somebody?
So,
Is that your job to do that?
oh yeah. I mean, what I'll do is we have options, right? And so, Dave doesn't need a credit score, which is great. He's got plenty of money and he doesn't borrow money. So we mere mortals probably need to have a credit score. And so, there's a couple, we can do that. Like I did with this couple, I said, we can go that path and you don't have to have a credit score. And then I showed them the difference between if you had a 660 score and you had a no score, and it was like significantly, it's like a half a point difference in rate in with the same cost. And so they were like, okay, we've been meaning to do it anyway, so let's do it. So I have found, dealing with the Ramsey cult, that actually I tell people we're Dave Ramsey friendly. We're just not a part of the cult. So we like a lot of his things. But what's that? I don't yell. Yeah. So I do roll my eyes to myself quite a lot when I see that somebody's got a car payment that's $1,200, $1,500, and like, oh my goodness, how even if I could afford it, I just can't bring myself to do that. But what I have found is that they're serious about it, right? If they've committed, and so I've at one time I would joke with folks, and they didn't like it, right? Because they were like, I'm getting out of debt, and I'm doing exactly what I'm told, and so I've been like, okay, now we can do a 15-year, 25% down, 20% down with a 15-year. That's great. I can do that. I'll just say that, keep in mind that you can always turn you can turn a 30-year into a 15 by paying more, but you're committed to a 15-year, right? So if you pay less than you would for a 15, if you try to turn a 15 into a 30, they'll probably take your house. So you don't want to do that, right? So, and especially people that are commission-based or anything, it's like, I can tell you exactly how to pay it off in the same amount of time. But rates, actually, somebody came to me yesterday, and the rate on a 15-year was quite a bit. It was 5.625 with about a point. I thought that was pretty good on a 15-year fixed. So, all right, what hurts credit score? Late payments, obviously. Maxed out cards. It says over 30% utilization. It just gets worse, right? So, and what I've found that if you've got one card that's at 100% and two cards that are at 5%, that one card is enough to break it. So I tell people, if you don't have the money to pay them all off, instead of taking one and paying it off and then go to the next one paying it off. Now that's okay with the debt snowball. It depends what your goals are. But if you want best credit score, then I would say, bring them all down. If they're all at 100%, bring them down to 90, all three of them, and then down to 80, and that type of thing. Because one of them is going to be an outlier and it's going to hurt your scores. So but if you've got one, then just pay it down. The ideal, I've been taught, but the ideal percentage is 8%. I don't know how, my credit guy has said for years that 8% is the sweet spot. If you pay it completely off, then the score's not going to be as good. And if you've got 10, 15, 20%, then it's going to be not as good. But for whatever reason, you can't see what's in the box. So they're like, when you deal with people that work, it's like they're shaking the box, they're smelling the box, they're trying to figure out what's in the box to be able to tell people what do you need to do to fix your credit. And through, the more shakes you get, the more at bats you get with that, then you start to figure it out. Did that didn't work. Did that didn't work. Okay, that worked. Okay, but then it didn't work this time. But what was different? So that's the advice that they've given us. Old collections. One of the things you have to be careful about old collections. Let's say you had something that it was charged off, or it just hasn't reported in years, and you say, I'm going to clean that up. That'll help me. So it hasn't reported in 3 years, and you pay it off. It brings that current. So sometimes it can hurt your credit. So you think, I'm trying, no good deed left, unpunished. So, I paid that $50 collection off, but now it became recent, and now it drove the score down. So you just have to be careful about some of those things. If you're gonna pay off cards, if you're gonna close any cards, close the youngest cards, not the oldest cards. We're splitting hairs here just to get the best scores. But if you're concerned about that, then close the youngest accounts, not the oldest ones. And then, try to avoid new accounts. It just, it isn't a big effect, but if your score's already low and then you try to get 3 credit cards and you get denied or whatever, then it starts to have a real impact. So. Yeah. So one of the things that we do is that we have I set my system up to do a soft credit pull. So whenever somebody fills out an application, there's no sign that their credit's been pulled. So I'm going to hand these out. So these are some quick credit links that you guys might find interesting. One is one of the reasons we do the soft credit pull is because we don't want the borrower to get hit with all of these unwanted credit calls, right? So they're going to. What happens is when we do a hard credit pull, if they haven't opted out, the first one is opt out pre-screen. So if you haven't done that, I would encourage you to do that. So what happens is the credit bureaus will sell your personal information. And so I have had a client I pulled his credit Wednesday afternoon at 4 o'clock. And by the time I met with him in person on Thursday, he had had over 100 phone calls and texts. And they're like, and not only are they saying, hey, we'd like to get your business. Some of them are saying, hey, this is Fred from your mortgage company, and we need for you to send them some documents. And people are confused. They're mad at me, right? I didn't know this was going to happen. Who is this person? And so I've started doing, actually what I've started doing is saying, I'm going to do a soft credit pull. And while I'm on the phone with the client, I'll say, would it be all right if I went ahead and opted you out? Because I have all their stuff. Because if I tell them to do it, that's what I did for years. And like, yeah, I'll get around to it. I forgot. And then, so I'm like, do you mind if I do that for you? Sure. So I just do it. Right? I can go on and I get a little certificate that says they've opted out. I drop it into our CRM if they ever needed it. So that way I don't have to worry about it. It takes 3 to 5 days for it to come into effect. So I can run my automated underwriting system for conventional loans without a hard pull. VAs and FHAs and the government ones, I have to have a hard pull. So usually, if somebody scores really bad, then I don't really matter. If it's on the low side, they're not going to get as many calls, right? So what happens is the lenders are buying those trigger leads. And so they're going to spend more for an 800 credit score than they would for somebody that's a 585. They may not get any phone calls because the scores are so low. It's like the probability of them being able to do anything is low. So they're not going to get a lot of calls. So opt-out pre-screen there. The next one is My FICO. If you ever wanted to see what your own scores are, and I can always pull and do a soft pull, but you can. It's My FICO is, Santa Claus is here. So My FICO is good. It's a paid service, but you can go on myfico.com, and it's like $39 a month, and you can get your mortgage score, your insurance score, all those different scores. And you can also do a what if simulator to say, well, what if I paid this down? What if I didn't pay that down? What happens in 3 months if I do this? And so that's really valuable. I used to have people, it depends on the person. So sometimes I'll just do the pull myself, but sometimes when somebody calls me 3 times, it costs me about $50 every time I do a credit pull, right? But I don't want to, I don't want to complain. It's like you all complaining about gas prices when somebody wants to go look at a house. It's like, well, it's a cost of doing business. So, but I've said this before, my bill last couple of months, about $2,500 a month just in credit pulls. So when I do a soft credit pull, it costs the same amount as it does a hard credit pull. So I've got to pull it twice. So, and people call back every 2 months and say, how's my credit? How's my credit? I don't think you're ever going to be able to buy anything. So why don't you pay for it instead of me? So I don't see it quite that way. Yeah, that's right. You're going to be in control. And so, this is what I see as a lender, right? So there's a link to that. And then actually I found when I was putting this together this morning, I realized that I did an interview with the founder of Credit Security Group. His name is Eddie Johansson. And so I did an interview with him, it's been about 5 years ago, I guess. And this is a link. It's on Facebook. So you can follow this link, and it's about an hour, 45-minute or something like that interview with him. And he goes through all these things in more detail than I do, if you're interested in that. So, and he's also the guy, he and his team are the ones that I refer people to. So the low-hanging fruit I will do, I'll say, if you pay this off, I think we're going to be good. And then if it's something that, this is a mess, it's above my pay grade, I'll say, I got a guy, right? Now, it's not free. So it costs, I think, about $150 for a consultation. And so what they'll do is they'll review their situation, review their credit report, and give them a plan. Sometimes that plan is something they can execute. Sometimes it's like, well, this is going to take an attorney or somebody to get this taken off, and they'll give them a price of what it's going to take to do that. And I use this kind of as a litmus test to say, well, if somebody says, well, I don't have $150, okay, then maybe you don't want the, okay, maybe you can't get a house either. Right? So I mean, but it's like, well, I'll give you something I'll give you everything I got. But if you're not going to go that next step because it isn't that important to you, this probably shouldn't be that important to me either. So that's the way I look at it. So that is one, and you can share those with your borrowers if you'd like. And then I was thinking, well, if I had questions, what would I have questions about? Well, medical bills and your mortgage, and credit scores. So this is just a little bit about how things have changed, and just beginning, actually just about now. They're supposed to not reflect medical collections are not supposed to be reflected on your credit score. Now, there may be some legacy stuff that's still on there that hasn't been cleaned up, but if anything happens new, then it should not show up on there. Okay, so there you go. You know, you got to be careful because some of the old bills may still be reporting. You know, if you paid, you know, well, it was medical. Well, you paid the medical bill with a credit card and then you didn't pay your credit card. Yeah, that's not gonna work. That doesn't mean that they still can't collect, because they're still going to try to collect that, but it shouldn't affect your credit scores. Yeah, the rule was on January 7th, but it was supposed to start in might have been last month, April 15th is when it was supposed to be fully in effect. So there's still some confusion about it, but but that's going to be helpful. I see a lot of medical collections. Will, you got that furrowed brow. You got a question for me?
Great, no, it's great information, man. I love these.
Well, good. Good. Matt, you always have
Something to say?
you have an opinion sometimes.
I think probably the best advice. I met Tim when I was a wee. Well, really though, because Ariel and I had our background in Bible, and then we went to real estate. And so I know people say, "Oh yeah, well back in the day, like no one could touch us because we were." It was like maybe you'll do good at real estate, maybe you can find something. So we had to get things going, and you talk to dad and family, and everybody's like, "You need a 15-year mortgage, you need to double up on payments, you need to do this, you need to do that." And so I remember the first time I said, "I know I can't buy, but I want a 15-year mortgage. I'm gonna double up on payments, and I'll do this or that." And that was like a really good, helpful advice that I give to a lot of folks is you can always turn a 30-year loan into a 15-year loan. You can't stretch a 15-year to the 30. And the difference in interest isn't too much, but that way too, you never know, because real estate, hey, cool, I just made 30 grand this month, woohoo, and then the next month, like, I made $0. Oh, look, I made $0. Hey, I made 15. You know what I'm saying? And we don't know what the future is tomorrow, and all that fun stuff is too. But at least you know, kind of too, as you're calculating your budget, a 30-year, if you're comfortable with that, great. If you are a Ramsonite and you want to get in there and slash away your debt, cool, double up your payments. Put it on. I think some of ours are on twice a week payment for a month type thing, which technically takes so many years out or whatnot. But do that. It's easier to do that rather than be in a panic. You're like, crud, I have to come up with this, and in 15 years it's paid off. So I thought that was really, really helpful, especially in our field. So keep that in mind. And then the credit utilization is super important, because I'm even trying to help people in this office and friends that I have that are like, man, I'm trying to get my credit score up so I can buy this or that. I'm trying to work this on my credit profile, and I didn't even get it. Ariel's one that's like, stop charging this in the car, use this other car. And I'm like, why? I'm paying it off. Like, she's like, do what I say.
As usual, yeah. Things are a lot easier when you just do what she says, right?
I know, that's why I'm growing my hair out. Hitting you again. Anyway, no. But you can't use too much, even if it's like, and I always too on this, anytime I can, I'm always asking for more credit. I don't use more credit, but I want
Unless you have no discipline.
When you got,
This is assuming that you have discipline in your life. I mean, I say I jokingly, but I did that. Like, I had, this was, well, I've told you the story about me losing everything. You know, I had a business and I had a lot of equity in my house, and I'm like, I just need $20,000 to help with the business, and they gave me an $80,000 limit. I'm like, no. I used every bit of that, right? And then lost the house and lost everything. So I didn't have discipline, right? So I have a lot more discipline now, right?
And that's like the biggest thing too. Is as we're talking about credit and building your credit card up. Obviously, this is using your credit card as a debit card, essentially.
Mm-hmm. Right.
That's how I've always. My mom has burned this in my brain when I was a little kid trying to get a Game Boy. And like, yeah, you can borrow this money here from me. Me and Dad will let you borrow it. And I was like, cool. And then I was bebopping around, and it'll be interest free because we love you, son. Cool. I don't know what that is, but I just want my Game Boy now.
Mm-hmm.
And I remember I got it, so ready to play it. I want that new Pokemon game, right? The yellow one. So I get ready to save up for it. I finally get birthday money or whatever, and I'm ready to buy it. My mom snatches it, and I was like, that's cool. Now you only owe me 25 more bucks or something. And I thought, oh no, there's something below zero. Like that's debt. So that's why I was like, I'm gonna pay off everything. But if you're using your credit card like a debit card, you will get paid by the credit card companies to own it. If you do it wrong, you'll be owned by the credit card companies, and it'll slaughter you, right? So use it as a tool. It's a terrible master. It's a good tool to build up your credit, and then too, my mom was the weirdo that put me on her credit when I was like 12. I don't know, something crazy. But she wanted me to build up my credit. My mom did not do well with credit. She put it on, so that's why it says that my credit's like 34 years old. And I'm 33, So all that stuff is helpful for little ones and stuff like that if you want to start building their credit now. But also, there are people I know that have used that credit to then go destroy it. Go get that car at that 15% interest rate or whatever. So it's all about the discipline. When you're telling this to your clients too, you're trying to help them. You can retain that client, because who here loves a call from someone that says, I got a 450, but I want to go see houses. Anybody really get excited about those buyers? Oh man, no hands.
They all send them to me, evidently, because I'm the one seeing those things.
Well, if you get those and you build rapport,
Mm-hmm.
and you feel that they're eager, I've had folks come back after like a year and be like, I did it. I can buy now.
Mm-hmm.
I just checked my credit scores here, and I'm pretty sure, and you pull it and they can buy, and they're super pumped. And that's super rewarding. But just, the more that you know about it, because not a lot of people who knew about any of this stuff about revolving credit, fixed credit, the utilization for how much you're using. Does anybody know that really well?
Of course.
Not a lot of people do, and like this is what we deal with all the time. And a lot of people go, "Oh, it's the lender's job." But if you can at least have some sort of knowledge, because that's the thing with realtors. That's why the biggest a lot of people don't like us right now anyway, because they think all you did was open a door and go, "Oh, cool, give me 3%, please." Right? So you constantly have to show your value. So if you can be a jack of all trades and a master of none, but can connect them to the masters of all, then you're the guy, you're the girl, right? So you're like, hey, this is how you build up your credit, yada yada. As a matter of fact, you talk to Tim here, and he can get you in touch with people, get your credit built up, right? And then that way, it's going to help you look like more of a professional. You're not just a pretty face that knew how to open a door with a Bluetooth thing, right? You're not just the agent that went, oh yeah, it looks like a good price. Right? So it just brings value.
Amen.
This is all super helpful.
Well, good.
I have a question too.
Yes, ma'am.
Like, check your credit for mistakes and fix them. So can you fix it?
I'm sorry, what was the question?
What's the process when it says check your credit for mistakes and fix them? Can you actually fix them, or do you have to go through other avenues to get them?
So you would I
Maybe
did.
repeat that.
Okay. So how do you on the sheet it says review your credit and fix mistakes. So when you look at a full credit report, you can see that these accounts may or may not be yours. So I'll go over with the client and I'll say, let's just go over some things real quick. You got this, this, and this, and they're like, no, that's not mine. I don't recognize that. I was like, okay, well, let's stop. Many times it's like, oh, I forgot I co-signed with so and so for that, or I forgot I had that. But many times it's, I don't know what that is. Okay, well, you need to go dispute that, and speaking of disputes, you have to be careful, because if disputes will take an issue and put it in like the penalty box, and it takes it out of the algorithm, and so your score may go up. But most of the loans that we do, you can't have a dispute, because we know that if you put it in dispute, your score is going to come up. So if it's appropriate, do the dispute and then get it worked out. But it can't be in dispute generally when we're doing a mortgage. So, but yeah, I would just go through and I tell this, like, people are going through divorces or whatever. Let's pull your credit. Let's look at it and say, well, I didn't realize that I had that, right? That's his or that's hers. And like, okay, well, let's go down here and cancel these things, right? Well, I don't know if you can get them, but you know what you're going into. That's the key. I think that, if I've talked to people that are, a lot of people call in, that are going through challenges, and I'll say, well, let me go ahead and give you a copy of this so that you can look at it to make sure that you've covered everything, and you've got your names off of these, or you make this a part of the settlement, that this is paid, or we're going to split this up, we're going to cancel, we're going to pay this off, those kind of things. So, but I think that's, and you can do what's called an annual credit report. It has no scores, but it has all of the information in it. So that costs nothing. And so I think it's annual credit report. Yeah, just annual credit report. And the bureaus will provide that. So, I think it's free once a year. Yeah. So, and that's worth doing, or, for, anyway, that's all I got.